What's up everybody, welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony, let's jump in. Happy Friday everybody, welcome to the end of the week. In a very consequential move and one that is being underreported, this week the Ministry of Finance announced that China will not expand the pilot property tax trial for this year, once again putting on hold much needed real estate reform. The day of the decision, state-run Xinhua expressed that although some cities have carried out investigations and preliminary research for the program, quote, the conditions for expanding the pilot sites for the property tax reform are not available this year, considering all aspects of the situation, end quote. This is a big deal. Beijing has been pushing for a property tax for well over a decade, and last year it looked like the country's leadership were ready to finally implement one, or at least start the process of implementing one, aggressively if necessary. But when Beijing officials started signaling the real possibility of rolling out a property tax, we saw immediate and sustained pushback. Indeed, we covered a lot of this pushback at the time. For though many agree that a property tax is needed, there are deep, entrenched interests that oppose such a move, including local governments which rely on land usage rights sales, property developers who have their own crisis at the moment, retired officials who are asset rich but income poor, and to a large extent the upper middle class which owns multiple apartments, also known as the urban elite. These groups are very powerful. In a sign that Beijing was not willing to spend the political capital that it would take to overcome these interests and these interest groups, a compromise was reached last year. In October of 2021, China's national legislature authorized a 5-year pilot program to test a new property tax in some regions. At the time, they did not specify what these regions would be. Again, we covered this at the time when this was first announced. The pilot measures were supposed to be expanded this year. The reason why this week's decision to pull back on these expansion plans for these pilots is a big deal is because it shows either just how worried authorities are about the real estate crisis, or it shows just how difficult it has become to get much needed reform passed, or some combination of both. After all, remember, this isn't even the nationwide tax that's being pulled back, just the expansion of a relatively limited pilot program. Some analysts are seeing this decision as a signal to stabilize investor expectations towards the property sector. We discussed yesterday, of course, statements from the government to try and calm some investors, particularly in equities. However, I would argue that there are less controversial ways to signal support for the property sector without pushing back one of the most necessary reforms that have been pushed by the central government for years. Ultimately, I believe what we are seeing here is yet another example of what we predicted half a year ago when Beijing started aggressively pushing the property development sector to deleverage. At that time, we said that it's well and good to call for reform at the beginning of a reform period, but I expected that once things got bumpy, as investors began dumping equities, as housing demand collapsed, as property developers start defaulting, as economic growth slows to politically unacceptable levels, then officials and policymakers would get cold feet and pull back on the measures most needed to achieve the reform, like a pilot trying to land a plane through heavy weather, but pulling back up as the turbulence gets too intense. The issue is kicked down the road a few more years, but it will still need to be dealt with in the future then too, and it cannot be postponed forever. Like our plane analogy, the pilot can keep circling above the storm, waiting for a better moment to punch through and land, but if the plane waits too long, it will run out of fuel and fall from the sky. Meanwhile, while we're on China's property sector, And speaking of falling from the sky, a report from this week from Chinese financial media outlet Yicai confirms that China's home sales have plunged over 22% in the first 2 months of 2022. Analysts, including the research director at real estate consultancy firm Consulting, generally expected these declines, accepting that China's real estate market has begun to go through structural decline. Looking at the data, we can see that the drop in sales is being driven by very weak household demand, combined with expectations of lowering prices. This is deeply distressing to the dozens of developers which desperately need revenue from sales to relieve their liquidity pressures. On Wednesday, the National Bureau of Statistics released new data which shows that average new home prices in 70 major cities that are surveyed dropped 0.12% lower in February, month on month. So this is compared to January, which also decreased. Now, this widens the decrease from January's 0.04%. It's been widened to 0.12%. Other data in the same report also shows that fewer cities reported increases in home prices. 27 of the 70 cities recorded a month-on-month increase in home prices last month, down from the month before. Local governments were set political demands that both land and home prices stay stable. So we can see why there is such a disconnect between the collapse in sales and the very modest decrease in prices. The question is, how long can this last? This week, US publication The Wall Street Journal published an article which has made quite a splash in the Anglophone world, discussing developments in the Saudi-China relationships. Some of you may already be aware of it. First, Saudi Arabia has invited General Secretary Xi Jinping for a state visit at a time when US-Saudi relations are quite cool. If Xi accepts, then the trip is expected to happen after Ramadan and would likely be Xi's first foreign travel since the COVID-19 pandemic began. But second, and this is what is raising eyebrows, talks with China over yuan-priced oil contracts will be on the agenda. These talks have been on and off for over 6 years, but have accelerated this year with growing discontent from the Saudis towards their relationship with the United States, it's reported. Quote, "The Saudis are angry over the US's lack of support for their intervention in the Yemen civil war and over the Biden administration's attempt to strike a deal with Iran over its nuclear program. Saudi officials have said they are shocked by the precipitous US withdrawal from Afghanistan last year." End quote. China is a big customer too, buying more than 25% of the oil that Saudi Arabia exports. It also relies on the Middle East for much of its energy needs, importing the majority of the oil that it uses domestically. The war in Ukraine is yet another reminder too for Beijing about the vulnerabilities that come with conducting one's international business in US dollars. Huge fluctuations in crude prices have been a headache for China in recent years, and the effort to stabilize commodity prices has frequently been on the agenda of China's top decision makers. Indeed, during the recent National People's Congress, Xi Jinping himself spoke specifically on the need to focus more on food and energy security. Then, of course, there is the geopolitical competition with the United States. This is what state media in China wrote yesterday. Quote, "If the Saudi consideration is turned into reality, it could mean a setback to the petrodollar system, a facet of the US's financial hegemony, and contribute to the decline of the dollar's reserve status, which the US has taken advantage of by printing as many dollars as needed to fund its spending for decades." End quote. So will it happen? Will we see yuan-priced oil contracts? Will we see the emergence of this Petro-yuan or Petro-RMB? Well, we need to ask, really, is it sufficiently in the interest of the Saudis to do so? And that is a little bit up in the air. China's highly restrictive capital account is a big turnoff. Simon Rabonovich of The Economist, for example, calculates that Saudi Arabia exports to China are about $42 billion and its imports are about $22 billion. If all of that trade was in RMB, Saudi Arabia would accumulate approximately $20 billion worth of RMB per year. What do you do with that $20 billion worth of RMB? If it was US dollars, it's fine, you can use it almost anywhere. You can buy products, services, or invest almost anywhere in the world. But with RMB, unless internationalization greatly accelerates in the coming years, you can only really invest in China. So the question is, with all the risks and costs weighed up, how attractive is this to the Saudis? I guess we'll find out in the coming months. Hey guys, I'd love to hear what you thought about some of the updates we covered in today's episode, so throw your comments below. Always love hearing from you. Thank you for watching. I'll see you next time.